Hi, everyone, and welcome to the Cvent Source, where we share the latest Cvent event and hospitality data and trends on a quarterly basis. And I know a lot of you've joined us before, so thank you for coming back, and welcome to all of you that are new to our program. Before we get started, let me walk you through some of the engagement features available on our webinar platform. I'm going to ask you to go right now in the chat area so you can get used to how that works. Go ahead and let us know where you're tuning in from. So thank you for tuning in from wherever you are today. Keep the chats coming. You can continue to use the chat and engage with other attendees and add your commentary or experiences based on what data we're sharing today. You could also use the Q&A area and put any questions that you have. We'll direct them to the right person and get you a written response during the webinar. And to download this slide deck and relevant resources, you can use the Resources tab on your right. You'll also be receiving a follow-up email with the link to the recording, so you can rewatch that or share with your team at any time. And with that, I'm going to introduce myself. I am Kelly Kopek. I'm a product marketer here at Cvent, and I work on the solutions that connect planners and marketers with suppliers like hotels and special event venues and vendors. And I work on solutions like the Cvent Supplier Network, our Cvent Vendor Marketplace, Cvent Passkey, which is our room block management tool, Cvent Event Diagramming, and Cvent Travel, all to foster collaboration and help both sides work efficiently together. And I also have my colleague Alex here, who is going to introduce himself as well.
Hi guys, Alex Platia, Director of Product Marketing for the Hospitality Cloud at Cvent. I work closely with hoteliers and destinations that leverage our tools to win and attract and convert more group business. And now I'll kick it over to Jan from STR.
Thank you, Alex. Good morning, good afternoon, good evening, wherever you may be. Thanks for the opportunity to be with you for about 15 minutes or so to give you the CoStar STR state of the industry. It is uncertain. I have to preface my talk with saying, based on what we know today, and these things, as you know, change quite a bit. So our forecasting company that we use, Oxford Economics, just revised their macroeconomic forecasting data down yesterday to 2% GDP growth. So our forecast that's here has not been revised yet. I don't know that we're going to revise it very much, given that we were already on the lower end of the forecasts from most of the other macroeconomic forecasters. So let's just blow through this and see sort of how that relates to where you are at. So let me start out, as I said, with the forecast. Last year, RevPAR grew by 1.8%. We're proposing that this year RevPAR is going to grow 1.8%. This is both times last year and this year driven disproportionately by room rate increases. The main thing to note is that the room rate increase is below the level of inflation. Whatever your sense of inflation is, 2.5%, pick your favorite number. We're proposing that the top line is not growing as quickly as inflation does, and that obviously then puts pressure on margins. In fact, if you take 2019 results and adjust them for inflation, today we are around 7% below where we should be if we had only kept track with inflation starting in 2019. And then you see we have a forecast for 26 and 27, but at this point, who knows, I guess, is the forecast. So we'll just keep in mind that we're proposing growth, but it's going to be slow growth. And where is that growth coming from? It's mostly on the upper end. This is the bifurcation story that we talked about in 2024, which actually is expected to hold this year. And bifurcation here means that the upper end of the market, luxury upper upscale hotels, are going to do much better than the lower end of the market, than the economy type properties. We are saying here that RevPAR for economy type properties is actually going up by 0.3%. That is actually a positive number. It's a positive, but it's also good to see because we used to see RevPAR deceleration. You're seeing here, if you are full service and have a lot of meeting space, the upper upscale type properties are actually driving most of the RevPAR increases for the industry. So up 3%, driven by an ADR increase that's higher than the level of inflation. Flipping back now to 2024, you see here a RevPAR percent change. This is the bifurcation story that played out last year when we sort of coined that phrase. Not a big surprise, I don't think. Full service, high-end hotels, hotels that cater to the high-end corporate traveler, to the high-end luxury traveler, did relatively better. The lower end of the market, the economy sector, the mid-scale sector that caters to the middle American who is on a budget and who then therefore has less travel budget available because everything gets more expensive, is then disproportionately impacted, and we see those chain scales take a hit and actually decelerated last year. What's interesting from where we sit is that we have the American economy grow, so GDP growth is up, but at the same time, we're not selling as many rooms as in 2019. How is that possible, that the American economy is now bigger than it was 5 years ago, but the number of rooms sold is basically flat? Part of the answer lies in this chart. What we're looking at here is not just the number of rooms sold from hotels, but also the number of rooms sold for short-term rentals and the number of rooms sold for cruises. And you see that all together, that still makes up the total pie of accommodations, the 100%, but that cruises and short-term rentals are taking out a larger bite. And that then means that, yes, everybody is selling more rooms except for the hotel industry. We're selling basically the same amount of rooms as we did a year ago, but that means our share of the total accommodation is declining. Cruises are certainly doing quite well, and of course short-term rentals here as well. Why we are still pretty bullish on the upper end is because we look at other indicators that seem to imply that the full service traveler is still doing quite well. This is just TSA throughput. How many people are flying through American airports? And what you're clearly seeing here is we are now counting more people through American airports than ever before. 900 million last year. You see, it was 2023 was basically on par with 19, and then last year we did better, and we expect 2025 that we will do better. The macroeconomic numbers notwithstanding, we think that people will continue to fly. Part of the problem, of course, is that for the high-end traveler is that they're flying abroad. They're not spending their US dollars in the US, they're taking them and going to Europe and going to Japan and going to Latin and South America. There's a lot going on here on this chart. This is not our data. This is data from, you see here, trade.gov, so the Department of Commerce. And what it does, it tracks international inbound and outbound counts through American airports. It's called the I-92 APIS data set. And the two numbers matter most are the minus 8.4% on the upper left-hand side and the plus 21.1% on the lower right-hand side. So plus 21% means US citizens departing from the US, going abroad, is today in 2024 was up 21% over 2019. 21% over 2019. Wow, that's a lot of Americans going abroad. But the inverse, unfortunately, is not true. 8% we have an 8% deficit compared to 2019 of foreigners arriving in the US. Why is that? Well, part of the answer clearly is the strong dollar, right? It's very expensive to come to the United States of America because the dollar is so strong. That means that Americans are taking their dollar abroad, but not a lot of Japanese or Germans or British citizens are coming here. Well, they're still, 59, call that 60 million or so, but that's 8% below where it was. And unfortunately, in times of uncertainty, I would think that the dollar continues to stay strong, which then implies that we will probably continue to see this imbalance of international inbound to outbound. Of course, the other part of this is the rhetoric out from the administration, out of the White House. This is under President Trump's first term. You see that the growth rates of international visitors to the US, either globally or overseas, which excludes Canada and Mexico, those growth rates shrunk drastically and actually in 2019 decelerated for the global number year over year. So we are quite worried, frankly, that the strong dollar mixed with, connected with the rhetoric from the White House will deter international travelers, be they commercial like corporate transient, or be they group travelers, or be they leisure travelers. So that's certainly something to watch. Switching gears a little bit and talking about group versus transient, a lot of you obviously are interested in how the group is, how groups are performing. The good news is that we continue to sell more group rooms. You see on the transient side here that we now sell more transient rooms than in 2019. Transient here are defined as rooms sold in increments between 1 and 9, and group rooms are defined as rooms sold in increments between 10 or more. And what you're seeing here is that, yes, on the transient side, new record. On the group side, not quite there yet, but growth 24 over 25, and hopefully that continues. With that then often comes pricing power, not in this chart, but in the next. Here first, I'm showing you for the top 25 largest markets, where are markets that showed room rate growth of over 2%. I'm using 2% here as a proxy for inflation, basically. Where were hoteliers able to drive rate on the transient side higher than the rate of inflation? And interesting, for example, Chicago, Minneapolis, Washington, Boston, markets that had not done well in the first stage of the recovery are now seeing some pretty healthy pricing power. New York is, of course, among them, 5%. That's a pretty good number. On the bottom, not a big surprise, I don't think. San Francisco continues to hurt. Nashville, had a sort of a rough year, and Las Vegas, also on the transient side, not doing great. But keep in mind that Las Vegas obviously is a large group market, which we see here. So on this chart, we're just looking at the group ADR increases 24 over 23. And clearly, because Las Vegas had the Super Bowl, that made their data much more positive than it would have otherwise been. Those 3 days or 4 days or 5 days in February really mattered. We just went through that with New Orleans with the Super Bowl this year. And obviously New Orleans in 2025 will have a really, really strong group year result. But who did well? Houston, Dallas, very, very strong. On the bottom, unfortunately, San Francisco, Phoenix, those are the type of markets where pricing power is still not there. Yes, groups are coming back to San Francisco. The pricing just isn't there. But you see for 18 of the top 25 markets, group ADR was above the level of inflation that I'm using here, 2% as a proxy for. So that's certainly a good news. So you have more group rooms sold, 24 over 23, and you have more pricing power. And I think both those things really help hoteliers with pricing going forward. And then when you listen to the publicly traded companies' earnings calls, they're very constructive on small groups, midweek, but unfortunately with very short booking windows. They're sort of in the quarter for the quarter, in the month for the month, with like 70 peak. You get a phone call and somebody says, hey, we got to get our team together for a quick team building exercise. And because we're not all in the office anymore, right, these smaller group meetings are really what's driving a lot of the group results. But hopefully then that means there's also some pricing power because they're booking the booking window is so compressed. Two things that we need to watch that have me a little bit worried. Number one is obviously, I have no doubt that we can sell the room, but who's going to clean the room? Who's going to service the room, right? Hotels and accommodations have 15% of people who are non-US citizens. And you can see here, this is according to tourism economics, landscaping services, services to buildings, crop production, construction, all those industries have the need for foreign workers, as does the hotel industry. And I'm very worried that the rhetoric from the White House, from the administration, is that we are not going to allow a lot of immigrants, legal immigrants in, and that there's going to be a deterrent factor, especially for people who are on temporary work visas, H-1B or J-1 visas. Those are the visas that you're using to staff your properties. And I'm really worried about what happens to those visa counts, especially for the back of the house staff, right? So the 15% non-US citizen employment by occupation, 15% is the average. Housekeeping is 30%. Laundry is 25%. So it's going to be super interesting to see what happens to access to those people. And likely, if other industries are hurting and not finding labor, they're going to drive up their wages, which means we will have to drive up our wages. So wage growth, I think, is certainly a topic for 2025. I think the other topic that's worrisome is insurance. This is not commercial insurance. This is from the New York Times about individual homeowners insurance. And they looked at areas facing great risk of fire and great risk of hurricanes. And what you're looking at here is the non-renewal rates in areas that are either low, moderate, or high risk of these risks, fire or hurricane. And you see that the non-renewal rates spike. And non-renewal means that the insurance company is basically saying, hey, this is now your problem. You know that for commercial real estate, that's not really workable. You will need insurance. But I'm wondering if, for example, hotels or resorts that are literally built on the water, what is going to happen to their insurance risk? If this is the trend that we are seeing for individual residential insurance rates, what's going to happen with commercial real estate insurance for properties that are in these high fire and high hurricane risk areas? So that is certainly also something to watch. So top line growth is there, but it's not very strong. And then middle of the P&L, probably higher costs from wages, probably higher costs from insurance. It's going to be interesting to see what that does to margins. Let me finish up with 3 quick slides, talk about the pipeline, because obviously you care about who else is building in your area. And the good news, if there is good news in the slides that I'm sharing with you, is that we are not overbuilding. Right? The number of rooms in construction has been between 150 and 160,000 for over 3 years. We're still at 154,000. I think the last number that came out was 150,000 even. It's basically flat year over year. What does that mean? It means some projects break ground, some projects open, but there's not this wide run up or this wide drop off. Now you see here that the number of planning rooms is up to 350,000. Is that worrisome? I don't know, because the number that really matters to those people that are in that planning phase is the interest rate. And the interest rate is not moving, hasn't moved, and now we're not sure where inflation is going and where unemployment is going. So maybe the interest rate is what it is, and that makes constructing a building very, very expensive. So I'm not super worried about the planning number here going up. What are we building? Not a big surprise. This chart used to be called, we're not building ballrooms anymore. And so that's exactly what we're proposing. So upscale, upper mid-scale is where the action is. Yes, 5% increase in the number of rooms that are in the luxury end if all those rooms opened tomorrow. So the math here is you take the number of rooms that are being built and you divide it by the rooms that are existing. That growth rate would be 5%. But of course, it's not really a growth rate, because you have to divide this by, 2 or 3, meaning these projects are coming online for the next 2 or 3 years. So certainly very, very manageable on the very high end. Limited service properties, yes, that's where the action is from the development side, from the lending side, from the brand side. But that's probably not where you're playing if you are in the meetings industry, because those projects don't have a lot of meeting space. And then lastly, really quickly, where else are rooms being added? This chart really hasn't changed over the last couple of years, well, for the last 3 years anyway. So New York, Dallas, Orlando, Nashville, Phoenix, those are the top 5, and those have been the top 5, and likely those will be the top 5 markets that investors find interesting, that developers find interesting. Very limited opportunity to build something in San Francisco. Just a lot of people are not sure that the market has fully turned around, and Minneapolis also only has, I think 2 hotels in the pipeline. So the action is in those markets that we had seen. So if you are in those markets, certainly look outside your back window. There is somebody building a hotel to compete with you. With that said, as usual, my last slide, if you found this interesting and want more of it, please tune in to Tell Me More, a hospitality data podcast. My colleague Isaac Halazzo and myself once a month get together and talk about the STR data and the latest trends that we see in the CoStar universe as well. With that said, thank you so much for your time, and I want to hand it back to the Cvent team. Thank you.
So Alex and I are going to start off by taking you through some of our trends. Because this is our first webinar of 2025, we're going to highlight what Cvent thinks will take center stage in 2025, and that's our 2025 event trend predictions. I'm going to start them off and then Alex will come on and finish them. So first that we predict is personalization at scale, and that refers to creating highly tailored experiences for attendees on a large scale using technologies like AI. Attendees, they're expecting customized content, recommendations, and interactions that align with their preferences and behaviors. And planners and marketers, they're looking to deliver on that attendee need without that extensive manual effort. So I mentioned AI already. That's the next trend on our list. And AI, it's really difficult to describe any of our trends without mentioning this trend of AI. It's becoming instrumental in creating efficiencies, especially in collaboration between planners and suppliers. And at Cvent, we have an extensive roadmap dedicated to making all of our audiences more efficient when it comes to sourcing event space, collaborating, and executing an event. And AI is helping with all of that. And last on this slide is data activation remaining a challenge. And that refers to the difficulties that event and hospitality professionals face in transforming the vast amounts of data collected during events into actionable insights. In the context of event trends, the challenge lies in dealing with the data overload that we all face. The abundance of available data, it makes it really hard to derive meaningful, actionable information. So overcoming these data activation challenges, it requires a structured approach to data management, including consolidation from various sources into one centralized hub. And this allows a more complete understanding of the event program and helps make more informed decisions. I'm going to go to the next slide and talk about return on relationships as a metric. And we also call this ROR. We think of this as a key metric that focuses on the value derived from building and nurturing relationships, both with clients and within the industry, because I think we all know that relationships are the cornerstone of success in events. ROR emphasizes the importance of the quality and strength of connections made through events, unlike traditional metrics that may fully focus on financial returns. ROR considers how well your events foster engagement, trust, and loyalty among participants. The next one is field marketing events driving growth, and that refers to those localized, smaller, and often regional events that are run by local field teams aimed at creating personalized and impactful experiences. These events, they include VIP gatherings, roundtables, and dinners, and many more different types, and they help build relationships and create deeper connections with the brand. Field marketing events, they've been increasingly recognized as a viable strategy to drive business growth by directly engaging local audiences and creating tailored event experiences that resonate more personally with attendees. And the last one I'm going to cover is event content fuels year-round campaigns. And that's a strategy to ensure material that's created for events, including things like videos, webinars, session recordings, speaker insights, and attendee interactions. All of that content, it's repurposed and utilized beyond the event itself to support ongoing marketing efforts. And this approach, it allows organizations to extend the life cycle of their event content and keep their audience engaged throughout the year. And then the last set of event trends, Alex will cover.
Awesome, thanks, Kelly. So the last three, so the first of which is unique venues and destinations remain popular. Event professionals and marketers, they continue to seek those ways to really make their events unforgettable without overspending. So special event venues and these unique destinations, they're really key in making these events and creating these standout moments. According to our 2025 Planner Sourcing Report, nearly half of the North American planners that were responding to that survey indicated that they're turning to unique venues for some of their events. That's a huge jump over the last year when only 17% of those planners said the same. The second trend here is tech supports accessibility. And of course, accessibility laws, they're evolving. Attendees expect compliant events with venues, hotels, and technology, it really plays that crucial role in supporting inclusive events for all. So make sure you're teaming up with vendors who provide these services for those attendees with disabilities. Ask the right questions in your registration forms. And lastly, create inclusive spaces at your events, including quiet rooms for attendees to ground themselves and ultimately decompress. And the last one here is about hotels and venues adopting smarter tools for data privacy. There's really that renewed focus on safeguarding personal data, and hotels are stepping up their efforts to ensure that compliance with the evolving regulations. Event professionals, they really need to understand how their attendees' information is protected, and hotels and venues, they really need to ensure that their guest data is never compromised.
And that wraps up all of the trends and predictions that Cvent has for 2025. Let us know what you think will be a top trend in the chat. We'd love to hear from you. And now we're going to move into the data portion of the presentation, and we're going to share the latest findings based on how customers are using our event and hospitality platform. We first want to explain how we get this data that we're about to share. And it's really all based on the powerful network effect that Cvent technology creates. And that's what we like to call the Cvent ecosystem. I'm going to start on the left side from the event cloud. And internally, this is what we call our event technology that empowers planners and marketers to create amazing events across in-person, hybrid, and virtual formats. We have 145,000 active planner users who sourced 3.1 million total group RFPs last year.
And with over 309,000 venues on the Cvent supplier network, these hotels and destinations use our Hospitality Cloud platform to reach these event organizers, showcase that unique event space, and ultimately collaborate and plan meetings and events of all types and sizes. And since the beginning back in 2008, over $158 billion has been sourced through Cvent. And because we power this events ecosystem, we've got a ton of interesting data that we'll showcase today. And you can refer to and use these benchmarks and trends to measure and improve your event programs, no matter where you sit in this ecosystem. So now that we've set that context, let's take a look at some of the recent insights we're seeing across the Cvent supplier network. And we're going to start with our traditional group business data before sharing more focus a little bit on our business travel and corporate travel trends. The headline here is that in-person events continue to grow. RFPs up 9%, room nights are up 10%, and the proposed rate growth is only up 0.2%. The slower growth in ADR means that the average rate at which hotel rooms are sold has remained relatively stable over the last year. Now, putting things in perspective, over the last several years, we've seen a significant shift in that growth in ADR, and it looks like overall these rates are stabilizing. Now, here at Cvent, we're always looking for more organizations to leverage our sourcing channel. In fact, we've got a team that's solely focused on these sourcing efforts within existing organizations that use our core event management technology, as well as a team that's focused on getting new organizations that haven't historically worked with us at all. Now, in 2024, nearly 70% of the organizations that were sourcing on the Cvent supplier network were new. And these organizations, they're not just your mom and pop shops sourcing a meeting space only RFP for a social gathering. You can see the average program sourced by these new organizations, it's just over 85,000. So as a new planner in the industry, you might be wondering, where do you even start? Well, you need everything at your fingertips, especially the digital tools, in an era where site visits might not be an option and you simply don't have the time to spend hours researching a destination or even a venue individually. That's why we built the Cvent supplier network, to make it as easy as possible to find a venue for your next event. And over the last few years, we'd often hear concerns about extremely short-term booking windows. We'd see significant shifts in the amount of room nights that were being sourced in the year for the year versus more than a year out. This is also stabilized. The percentage that you see on the screen here reflects when these room nights are being sourced. And for more context, in 2024, 30% of those room nights were sourced in the year for the year, 42% were sourced between 12 and 24 months, and 28% have been sourced more than 2 years and beyond. Now, why is this important? Well, as a planner, for those events that might be larger, it's a good indicator that you're going to have to start that sourcing process earlier rather than later, especially given that 70% of the volume is more than a year out. Later on, Kelly's going to share a bit more on the full life cycle of an event, from that event creation in Cvent to the event start date. So now when you factor all of the above, planners often need to shop around for many reasons. It might be that venues are at capacity, it might be budget, but in some cases, it's not just the venue, they might even be considering multiple destinations. And as you can see here, 75% of RFPs are sent to a single metro area, 25% are sent to 2 or more metro areas, and 14% are sent to 3 or more metro areas. So nearly a quarter of the time, planners are considering at least 2 destinations for an upcoming event. Now, planners aren't just looking at US for their events, international meetings are back. In 2024, more than 130 countries have been sourced by planners from the US. And that's more than 4.4 million room nights. And then over 3,000 planners have sent an RFP internationally. And on the flip side, international volume continues to return to the US. In 2024, over 1,700 international planners sent an RFP to the US, up 31%. And collectively, they sent nearly 1 million room nights. Now, when you take a look at the growth in room nights across the world, the Americas leads the way, up 11% year over year. Europe's grown 1%, and the next 3 have actually decreased slightly. So the Middle East and Africa has decreased by 7%, Australia has decreased by 8%, and Asia has decreased by 5%. But I wouldn't worry too much here because the previous years they had seen more growth. It's just they're not growing as much as they had previously grown over the last year. And when you look at room nights for the top 20 metro areas in the United States, we really have a North America audience today, and that's why we're going to kind of dig into where these RFPs are being sourced. So what we're looking at here shows how these markets compared to 2023. All markets were up with the exception of Denver and Miami. Now that's great news for the top 20, and while not shown in something that I alluded to earlier in the trends, we're seeing strong gains in the tier 2 and tier 3 markets. Now, let's take a quick look at what this growth looks like when we look at it with respect to the proposed rates. So Europe's up over 2.4%, Asia is up 3.3%, and the Americas and Australia is relatively flat. Middle East and Africa is down 2%. So again, not too much change in the ADR over the course of the last year, which is a good sign on the planner side. Now, when we look at this by chain scale, again, you're going to see that while the number of room nights in purple is up across each, the change in the rate growth in blue is rather minimal. And in some cases, it's even negative for luxury and independence. So if you are looking to have those events at venues that are luxury or independent, the price should be slightly lower in this case for the next year. Now, something that we look to do more of in 2025 is really bringing together the data we have from our Cvent transient travel product, and together with our data on meetings and events. So over the last year, you're seeing a flattening of that average corporate travel rates year over year. And when you compare this to the meeting and group side, or as per CSN, group rates tend to have that higher rate overall than the business transient. Now, in North America, the trend for group rates is that the lower the tier, the higher the increase in the rate. And for corporate travel, except for North America Tier 1, the business travel rates are seeing minimal uplift. Elite markets are seeing the highest increase in business travel rates at 1.3%. Now, easier said than done, it's a lot of effort to create a perfect event. And we're a witness to all the hard work put in by event planners and suppliers through our platform. And we all know about the challenges and difficulties that hoteliers have gone through over the last few years from that staffing perspective. Planners, they're also very conscious about collecting responses from a wide range of venues. On average, they include 10 venues across 8 brands for each RFP. And in return, when they send out that RFP, 5 venues will bid, 4 venues are going to turn that RFP down, and one's just not going to respond at all. And since planners aren't getting either enough responses or quality responses that fit their needs, they're sending that same RFP to another batch of venues approximately 40% of the time. Sending RFPs, evaluating the responses, and selecting a venue, it's a lot of work, but that's what's going to make it that successful event. Now, if you look at why suppliers turn down the business, 60% of the RFPs are turned down due to unavailability of either guest rooms and meeting space or date patterns. And if you don't feel like you're getting enough bids back as a planner, take advantage of submitting that RFP with alternate dates. This past year, planners were flexible to accept alternate date proposals on 43% of the RFPs that were turned down. So for all the hotels watching today, pay attention to the planner's alternate dates. You might still be able to win that business, or at least start building that relationship for the future by paying closer attention to the RFP details. This is one area where we're working really closely with suppliers. Small things like this can really create that better ecosystem altogether. So now that we've covered the insights from the Cvent Supplier Network, Kelly's going to take us through the data from our event marketing and management platform.
Thanks, Alex, for those insights. And as he mentioned, we're going to get into the event data to see how event organizers are strategizing and executing events this year. And I'm going to start with the life cycle of an event. And this ties back to some of the booking window data that Alex was sharing. And we've plotted out 5 key milestones through our data. That's event creation date, RFP send date, RFP awarded date, event launch date, and lastly, the event start date. And the average duration of an event from the creation date to the event start date, that's 170 days or 5.5 months across all sized events. Event organizers are on average sending out RFPs about 4.5 months out from an event. Now, if that seems a little quick, it's true that the size of the event will clearly impact this timeline. So let's look at this timeline based on the size of the event by the registrations. And for those smaller events with less than 50 attendees all the way at the top, from start to finish, it's shorter actually than what we just looked at. It's about 4 months. Planners are usually sending those RFPs out approximately 100 days from the event start date in the case of small and simple meetings, 50 registrations or less. And for the largest events that we're seeing on our platform, if we look all the way at the bottom, and that's the 1,000+ registration line, on average, planners are sending the RFP, or they're starting the process at about 7 months out. Their planners are sending their RFPs approximately 180 days out from the event start date. So you could see the variance based on the registrations. And I also wanted to cover some of our growth stats for 2024 holistically over 2023. Overall, the number of events grew 3% year over year, with registrations growing at around the same pace at 4%. What actualized with events taken place in 2024, it's fairly consistent with the RFP volume and room night growth that Alex showed earlier. Planners did more events that were slightly larger than what they were in 2023. Now, this slide is breaking down trends that we're seeing with the number of events within each of the industry segments' total event program. And this is a comparison of all of 2024 compared to 2023. Of the top 10 industry segments, overall, they did more events in 2024 versus 2023. More than half of financial services, nonprofit, business services, software and internet, and government companies did more events than last year. Government, manufacturing, and nonprofits were least likely to do less events in 2024. Similarly, let's look at event registration trends by industry segment. Our data shows us that registration growth was up 4% year over year. We looked at that already. And it looks like nonprofit companies and third parties were the main drivers of that increase, as they saw 11% and 18% more registrations across their event programs, respectively. Associations and manufacturing saw a reduction in registrations across their event program, down 8% and 4%, respectively, while the rest of the industry segments fell relatively flat with registrations 2024 compared to 2023. Here you can see the evolution of event formats starting in January of 22. So at the beginning of 2022, let's go all the way back, in-person events, they were making up 42% of event programs, while 53% of events were virtual. The major shift that happens from January 22 onward, it's the amount of the blue getting larger and the yellow getting smaller. So that means we saw more in-person events and less virtual events as we progressed into 23 and 24. And this trend started in mid to late 2022, and it's really held true in 23 and 24, with most months in 24 seeing over 70% of all events happening through an in-person event format. Doubling down on that trend, we looked at event programs to see what the typical event format mix was for a Cvent customer. 91% of event programs leveraged in-person formats in 2024. And for comparison, This is up from 89% in 2023. 39% of programs contained hybrid or virtual event formats in 24, which is very consistent with what we also saw in 2023. And finally, 11% leveraged all three formats last year, and that compares to 8% of event programs that leveraged all three formats in 23. The trend is still shifting towards more programs containing in-person events, with more customers also leveraging all three formats when it makes sense to them to use that mix. If we look at the use of event formats across industry segments, we see similar trends to what I just went over. Healthcare, education, and financial services are the most diversified with event formats, more likely to rely on all three formats, with healthcare leading the charge significantly, with 22% of organizations leveraging all three. Healthcare, education, and government, they adopt hybrid and virtual event formats more often. Manufacturing, healthcare, and third parties are the top industries to rely on in-person event formats, with manufacturing being the clear leader, with 97% of organizations leaning into the in-person event format for their programs. Now, I'm going to share insights into when customers are starting events based on event duration and format. We see that in-person events start earlier in the week as the duration of the event increases. And for shorter in-person events, planners are choosing Wednesday to start. For shorter virtual events, Thursday is the most popular start day. We see the bleisure trend in full effect, as we've seen in the past. In-person events tend to start after, or they lead up to a weekend. Event attendees are staying before and after events to experience the destination and enjoy leisure time. It makes sense that we're seeing customers design their event programs with attendee preferences in mind. Hotels and planners, they should look to convert event attendees into bleisure travelers by adding shoulder nights or special promotions in the booking process to see increased attendance, occupancy rates, and add customer loyalty. Now, this is my last slide before we get into a couple of more comments. And it's always interesting to see where attendees register. Sorry, not where they register, when they register for events. And here we're looking at registration timing by event format. Nearly half of all in-person registrations happen within 4 weeks of the event start date, while 77% of registrations happen within 4 weeks for virtual events. So with the majority of registrations for in-person events happening more than 4 weeks out, you should adjust your sales and marketing campaigns as well as registration predictions to accommodate these behaviors. And I know we do that for our marquee hybrid event that we're going to talk about in a little bit called Cvent Connect. And we benchmark our numbers year after year and know how many attendees we can expect to see within those last 4 weeks. And then for comparison to this data, in 2024, we saw around 20% of all of our registrations. They happened within 4 weeks of the event, meaning that about 80% of those registrations happened more than 4 weeks out. So it's definitely not a one-size-fits-all approach when it comes to event timing based on the event type. And thank you all for joining us. That is the last data point that I have to conclude us today. And the next time that we're actually going to do this session, we'll be streaming live on stage to an in-person and a virtual audience at Cvent Connect. So I hope you all can join us there. And I'm actually going to bring on Alex to talk to us a little bit more about Cvent Connect and what you can expect if you're interested in attending or if you're already registered.
Yeah, believe it or not, it's hard to imagine, but we're less than 90 days out. So Cvent Connect will be again in San Antonio and hosted virtually June 9th through June 12th. Cvent Connect is our annual user conference, and it's really the go-to annual event for event professionals, marketers, and hospitality experts. So whether you're shaping event experiences, driving marketing strategy, really looking to connect with planners or marketers, this is really where you need to be in order to come together, swap ideas, explore that cutting edge tech, and ultimately walk away with fresh inspiration. So mark your calendars. We'd love to see you there. And again, we're just a few short months away and really looking forward to it.
Awesome. Thanks for that, Alex.
Sure.
All right. And final thing, if you'd like to earn a $100 Amazon gift card, please sign up to complete a demo with us. Just click the button that will pop up right now at the bottom of your screen. Or if you're watching this recording, you can click the button in our follow-up email. And to any recipient outside of the US, the gift card can be converted from $100 USD to any currency available of your choosing. So make sure to take advantage of that. And that concludes us today. Hopefully you got your questions in and we tried to answer them all. So you should have gotten a response, and we'll see you guys next time for the Cvent Source.